As I'm sure you're aware, with universal life, one of the beautiful things about universal life is its enormous flexibility. And one of the things we can do, of course, is start off with a minimum premium, but we can also put in maximum premium as well. So in other words, the difference between a minimum and maximum, basically extra money going in, will build up that cash accumulation and so on and so forth. And as I stated before, as long as the maximum only goes up to basically the MTAR line, the growth in that plan is tax deferred, basically until you actually withdraw the money at the other end. So it's a very, very excellent way of tax sheltering money. Now, of course, Ottawa knows this. Okay, they know that people don't necessarily buy universal life for the purpose of insurance only. They may also buy it for the purpose of avoiding paying any kind of taxation, just like they buy an RSP, for example, to avoid taxation for the future and so on and so forth. They say, well, you also use universal life for the same purpose. And remember, the idea of universal life, the idea of any insurance, is to provide death benefit. That's the ultimate aim. However, recognize the fact that universal life has minimum and maximum. They're saying, okay, it could be an investment product, in which case then you lose that exemption that we were talking about before. So how do we protect ourselves against that kind of thing? So what has happened is we have what's called an anti-dumping rule. Okay, very important rule, an anti-dumping rule. And basically, it's commonly known on the street, you might say it's commonly known as the 250% rule. And so that 250% rule is key to the whole thing of making sure that the policy remains exempt at all times. Okay, so the idea of this rule basically is to prevent a policyholder from making very large sum deposits. In other words, the person just plows in a whole pile of money in the hopes that the whole thing will be tax sheltered. And then Ottawa will tax defer and all that. Well, they said, no, that's an investment. So we're going to put a limit to the amount of money that you can actually defer. And that limit is going to be 250%. We're going to impose a 250% rule. So that applies once again for policy December 1st, 82 onwards and not before, okay? So it applies from year 7 onwards. In other words, at the 7th year is when this actually, the 250% rule kicks in. So the 7th year basically is where the starting point is. So the actual calculation, however, begins on the 10th year. And then every anniversary thereafter, in other words, on the 10th year, what happens is they're going to go back to year 7. And they're going to say how much money did you have in year 7. And then you multiply by 250, we'll see an example in a moment, and that'll be the amount of money you can put in. And then in the 11th year, they're going to go to 8th year. In other words, it's always 3 years behind, basically. So the anti-dumping rule basically kicks in at the 10th year, but it goes back to the 7th year in terms of how much cash is actually in the policy itself. And it multiplies it by 250, and it's okay. The maximum you can put in is this many dollars, and no more than that, in order to stay exempt. If you wish to put in more money, that's fine. But remember, you could lose your exemption status on that as well. So it is important that we stay within the 250% rule. So here we've got Bill sitting here. And he's got cash value on the 7th year, year 7, of $50,000. That basically is the amount of money that he's got in that particular year. Okay. So on the 10th year, the maximum dump in that he can do is $125,000. And how we got that $125,000 is 250% of $50,000. In other words, the $50,000 was in the 7th year. The 10th year, they multiply what was in the 7th year, which in this case was 50. It's okay, you can write a check for $125,000 and you're good. Basically, the policy will stay exempt and so on and so forth. Okay? And then next year, they'll do it all over again. Okay, they'll say on the 11th year how much money that you have, and the 8th year multiplied by 250, and so on and so forth. Okay, so as you can see that as time goes on, you can put in more and more money into these policies. So in the early years, it's relatively limited. Okay, but not as you move along. If you have been in fact putting in the maximum every single year, it's quite substantial that as the years go on, you'll be able to put in more and more because of that 250%, but no more than 250 in order to stay exempt. If exemption is not an issue for you, then that's fine. You can put in whatever amounts you want. But if it is an issue for you, then you must stay within the 250% rule. So that is what they refer to as the anti-dump rule. So I know that's